Last year, your bank made around $700 off the money sitting in your account. Your cut, maybe 50 cents. You didn't agree to that. Nobody showed you the math. But every single day, the money you worked for is quietly making someone else rich, and it isn't you. Most people think a bank is a safe little vault. You hand them your money, they lock it away, and it waits for you. That's the story. The truth is the exact opposite. The moment your paycheck hits your account, the bank stops treating it like your money and starts treating it like theirs. By the end of this video, you'll see exactly how they do it in real dollars and how much it's costing you every year you do nothing. Let's start with the trick they're least proud of. When you put $10,000 in a normal checking account, the bank pays you almost nothing to keep it there. The national average on a basic account is about 0.01%. On $10,000, that's $1 a year. $1. But your money doesn't sit in a drawer. The second it lands, the bank lends it back out. They lend it to someone buying a house at 7%. They lend it on a car loan at 9%. They put it on a credit card at 22%. So your $10,000, the money they paid you $1 for, earns them $700, $1,000, sometimes $2,000 a year. That gap has a name. Bankers call it net interest margin. You can call it what it is. They rent your money for pennies and lend it for a fortune, and they keep every cent of the difference. You're not a customer. You're their cheapest supplier. Now here's where it gets stranger. You probably think the bank can only lend out the money people actually deposit. It can't lend what it doesn't have, right? Wrong. In the United States, since 2020, the amount of cash a bank is legally required to hold against your deposit is zero. 0%. When the bank makes a loan, it doesn't move your dollars to the borrower. It simply types a new number into that borrower's account. Brand new money created out of nothing, backed by a promise to pay it back. Your deposit just makes the whole thing look safe. So the money in your account isn't really sitting there waiting for you. It's been multiplied, lent, and relent across the entire economy. The bank is running a machine, and your savings are the fuel they got for almost free. Which raises a very uncomfortable question. If your money has already been lent out, what exactly do you own? Legally, the answer will surprise you. The moment you deposit money, it stops being yours. It becomes the bank's. What you own is an IOU, a promise from the bank to give it back when you ask. You are not a vault holder. You are a lender, an unsecured creditor of a company that's loaning your cash to strangers. That's why, if the bank fails, you don't get your exact dollars back. You get in line and you hope the government insurance steps in. That's also why deposit insurance only covers you up to $250,000. Above that, your money is riding on the bank's bets, whether you agree to it or not. Now let's talk about the part that's pure profit. Fees. Banks in America pull in billions of dollars a year just from fees. Overdraft fees, maintenance fees, minimum balance fees, ATM fees. A single overdraft, you spending $5 you didn't have, can trigger a $35 charge. And here's the ugly part. These fees don't hit everyone equally. They fall hardest on the people with the least, the ones who can't keep a high balance, the ones living paycheck to paycheck. The customers with the least money pay the bank the most. The system isn't broken, it's designed this way. The less you have, the more you pay to hold it. And then there's the silent one, the thief that works while you sleep. Even if your bank paid you a fair rate, inflation is eating your savings the entire time they're sitting still. At 3% inflation, money in a zero-interest account loses about a third of its buying power in just 12 years. The number on your screen never drops. What it can buy quietly collapses. So picture what's really happening. You hand the bank your money, they pay you almost nothing. They lend it out at high interest and keep the spread. They charge you fees on top, and inflation chips away at whatever's left. 4 different ways the same dollar works against you, all at once. That's not a vault. That's a business, and you are the product. So what do you actually do about it? You stop being the cheapest supplier. You make your money demand a fair price. First, that emergency cash sitting in a checking account earning $1 a year, move it to a high-yield savings account. Same safety, same insurance. But instead of 0.01%, you earn 4, sometimes 5%. On $10,000, that's the difference between $1 a year and around 450. The bank was always earning that. Now you do. Second, never let large amounts of money sit idle in checking. Checking is for spending, not for storing. Idle money is the bank's favorite money because idle money is free money for them. Third, watch the fees like a hawk. Every overdraft, every maintenance charge, every penalty is a tax for not paying attention. Switch to a bank or account that simply doesn't charge them. They exist, and they're free. And finally, understand the game. The bank is not your friend, and it's not your vault. It's a business that makes money the longer you stay passive. The single most profitable thing you can do for them is nothing, so do something. Here's the truth nobody at the branch will ever tell you. Your money was never just sitting there. It was working the whole time, earning, lending, multiplying. The only question was who it was working for. For most people, the answer is the bank. Now that you can see the machine, you can finally make it work for you. The bank isn't stealing from you in the dark. It's doing it in plain sight on every statement, in numbers too small to notice. And the day you start noticing is the day it stops.